Okay, time for another video update. It's October 3rd, 4:25 p.m. Market just closed. I want to revisit the idea that the U.S. equity market is in a secular bear market. For those who haven't seen any of these videos or read the newsletter, you might be asking, well, how could we be in a secular bear market when the U.S. equity market is at all-time highs? Well, I'm defining a secular bull market as one that, relative to inflation, generates double-digit annualized returns over a 10 to 20-year period. And a secular bear market is one that generates essentially 0% real returns over a 10 to 20-year period. So it just keeps pace with inflation. So if we look at this chart is the real returns of the U.S. equity market. So it's the total return of the U.S. equity market divided by the headline CPI number dating back to 1926. So as you can see, the blue and the green segments are secular bull markets. The market essentially goes up, and that's relative to inflation, so it's moving up strongly relative to inflation, whereas the red and gold segments are secular bear markets. That's where the market just keeps pace with inflation. Sometimes it makes a little bit more than inflation, sometimes it makes a little bit less. The red segments are driven by low real earnings growth, and the gold segments are driven by high inflation. So it's my contention and belief that we are currently in a secular bear market driven by high inflation. As you can see, if that secular bear market started at the end of 2021, beginning of 2022, then we are barely above that late 21, early 22 high relative to inflation. So we're just keeping pace with inflation. Maybe we're up a few percent relative to inflation. And to get there, the U.S. has had to take on essentially, the third worst valuations of all time. Here's a chart that shows our preferred equity valuation metric, the aggregate investor allocation to equities, which is simply the ratio of the total market value of equities divided by the total market value of equities plus bonds plus cash. So it's basically the percentage of equities in the entire market portfolio, if that market portfolio consists of equities, cash, and bonds. At the top of the dot-com bubble, this ratio was at 0.527. At the top of the everything bubble at the end of 2021, it was at 0.518. Now it's at 0.512. It was actually at 0.514 last Friday. The market's fallen a little bit this week, so this metric's come down a little bit. But nonetheless, if the equity market in the U.S. appreciates above 6,000, the S&P is at 5,700, a little bit more. If it goes up another 6 to 10%, we will likely surpass these levels, depending on the time frame in which it does that. If it does that before the end of the year, almost certainly will surpass the everything bubble, and we may actually surpass the dot-com bubble as well. So whenever valuations are at this level, that's where secular bear markets start. It's not where secular bull markets start. It's not where secular bull markets have another 5 to 10 years left of lifespan. It's where the brakes get put on and equity markets have problems. If you look at the valuation expectation, this is actually starting to curl away from the black line. So the black line is the forecasted, the blue line is the actual. It tracked very well historically. Yeah, there were some divergences here in the early to mid 90s and again in the mid 2000s. But whenever Jerome Powell opened the floodgates during COVID, we see that valuations have drifted decently far from this black line expectation. Now, the question is, does that mean this indicator doesn't work anymore, it won't work anymore, or does it mean that it will have a huge period where it catches up or catches down to the black line? I believe it will catch down to the black line. It seems like there are so many things that could go wrong given the fragilities that the U.S. faces with its deficit situation, with equity valuations at highs, with sort of the AI bubble and the expectations that have been built into that versus what we're actually seeing in terms of reality, monetization versus what's been invested. The monetization of AI at the retail level hasn't really made up for all the investment that's been put into it. So that's another fragility. We're on the verge of World War III, which could lead to food shortages and commodity shortages and electricity shortages and gasoline shortages. which will drive inflation, which will really hamstring the consumer, which will torpedo corporate earnings. With valuations at all-time highs, it's not a good place to be. So I do think that this blue line will eventually catch down to this black line. From a risk premium standpoint, equities are currently yielding 3.5% less than the 10-year bond. So if you were to hold the 10-year bond for 10 years versus holding equities over the next 10 years, it's likely that on an annualized basis over those 10 years, the bonds would outperform by 3 to 4%. Now, we are, in my belief, in a secular bear market driven by high inflation. Inflation has come down, the Fed has started to cut, but there are a lot of headlines in the news that kind of give you an indication of where inflation could start to make a comeback. One would be being on the verge of World War III. Here's a tweet that says oil surges on report Biden discussing strike of Iranian oil facilities. Oil rising on that news. It was up several percent today. So that's one avenue where inflation can make a comeback if we start to get into a hot World War III, simply with commodity shortages and hitting oil fields and what have you. So that's one area. If we look at crude oil, it seems to have a potential floor at around $70. Below 70, and the U.S. starts to lose market share to OPEC, so they want to keep it above 70. They probably want to fill the Strategic Petroleum Reserve before they engage in World War III, so that will likely lead to upward pressure and buying pressure on oil. Oil is most likely in a secular bull market. Its secular bear market probably ended when oil went negative in April of 2020. It's up, massively since then. It's been consolidating. If this was the rise over here in 2022 when Russia invaded Ukraine, we had that spike. It's been kind of consolidating its prior gains for the last 2.5 years, but it's due to essentially start another leg of its uptrend given the secular environment, and we might be seeing that nascent uptrend starting now. Same thing with commodities. Both commodities and oil look potentially like descending triangles. Those typically resolve lower, but in the secular environment we're in, if they do resolve lower, that would probably be incredible buying opportunities, given that they likely won't stay down for long. But they might not even break lower. This is GSG. It had this big run from April 2020 to the Russia invasion of Ukraine. It's been consolidating since then, but it looks like it might be starting to creep higher, and maybe it is also starting its next leg higher in this secular bull market for commodities. If you look at energy stocks, they're much higher than they were in 2022 when Russia invaded Ukraine. Even though oil's lower, that's because they keep stacking earnings, becoming more valuable as companies. Their valuations aren't excessive. I would expect energy stocks to be among the best performing assets over the next 5 to 10 years, if not longer, if that's how long this secular cycle lasts. But energy stocks are holding up quite well, given how the drop that oil faced recently. Oil dropped maybe 25%, and XLE dropped maybe 10%. So that's a pretty good, it held up quite well given what oil did. Another thing to consider with respect to inflation, so the ISM services came in today on the high side, and if you look at the prices paid number, it was 59 versus an expectation of 56. So again, inflation might be making a comeback. And then you also have the situation with the dock workers on the East Coast in Texas. They're striking because they want a 77% increase in wages over the next 6 years. 77% over 6 years annualizes to exactly 10%. So they want essentially 10% wage increases every year for the next 6 years. That is a way to drive inflation if those wages are accepted, or if that's they probably won't be that high, but maybe they get negotiated down to 7 or 8%. Nonetheless, those prices will probably flow through into the prices of other goods and services. And if they don't, then profit margins will fall. So if wages go up and that increase in wages isn't passed on to the end consumer, then that means the profit margins are falling. And if profit margins are falling, that means earnings are falling. If earnings are falling with equity valuations at all-time highs, that can't be good for equities. But if they do pass along those costs, well, that can't be good for inflation. So again, a lot of fragilities. It doesn't seem like, it seems like whichever way things play out, the end is likely not auspicious. We also have, so I didn't know this until this weekend, but there is a place in North Carolina that got hit by the hurricane, a place called Spruce Pine, North Carolina, that produces the quartz that's used for semiconductor manufacturing. And supposedly this quartz is the purest in the world, and it's the most sought after, and it's what they use for semiconductor production. So I was a little bit skeptical. So I said, is it true that the quartz needed for semiconductor manufacturing is only found in Spruce Pine, North Carolina? So I typed this into ChatGPT, and you can see what it said. It said it's not entirely true that there's quartz elsewhere in the world, but the quartz in Spruce Pine tends to be the highest quality and the most sought after. So if we have disruptions in that production, that would likely lead to semiconductor price inflation, and semiconductors are in everything. Microchips are in everything. So, again, another pathway for inflation to come back. If we look at what gold is doing, gold is also telling us, it's screaming at us that we're in a secular bear market driven by high inflation. Recently, the positioning landscape for gold has been one that has typically led to gold falling and falling strongly, but not this time. It's up, I think, 15% from where the positioning landscape turned bearish. And it's also, about 15% higher, 16% higher than its 200-day moving average. So maybe it pauses in the near term, maybe it pulls back a little bit, takes a little bit of a breather, but the fact that it's been so resilient, it's either screaming that we're headed for a recession and there's going to be a blowout in the deficit, or that we're heading for World War III and people want a safe haven. It could be screaming that central banks are acquiring it because they know that holding long duration bonds will lead to negative real returns over the next 5 to 10 years. Whatever the case, and it could be a combination of all of those, gold is strongly indicating that we are in a secular bear market driven by high inflation, because what asset would you expect to do well in such a situation? Gold. The last time we were in this type of secular environment was the 1970s into 1982, and gold, when the gold window was closed and it was allowed to free float against the dollar, it went up massively. So again, another indication that the secular environment is not favorable for stocks and is favorable for commodities and gold and energy stocks, etc. Here's silver. Again, silver, for the longest time, the last decade or so, it couldn't hold any gains. Now it can't hold any sell-offs. It's like a ball underwater. So once again, another indicator that the secular environment is one driven by high inflation, and inflation could be on the verge of coming back, which would limit how much the Fed could cut rates, which would probably cause a lot of problems given how much the market is pricing in with respect to rate cuts over the next year and a half. Here's the dollar. So looking at the dollar, let's end the inflation discussion temporarily and see what the dollar is doing, because it does drive a lot of the macro movements in the markets. After the Fed rate cut, we had this move lower below this horizontal line, and it was my speculation that maybe it was a false breakdown. And if it's a false breakdown, then you would expect the dollar to rally vigorously in the other direction. It tried to bounce. It had one big up day last week, but then it came back down to kind of retest this low. And after the end of last week, I thought, okay, well, no, this isn't a false breakdown and rally, because it's just not rallying fast enough. But this week it's up, through 4 days, it's up 1.6%. And as you can see, those are some decent sized green candles. And if we get a strong NFP report tomorrow, after getting the strong ISM reading today, then it's possible that we continue higher with the dollar. And maybe it is a false breakdown and rally, and people who were short the dollar at those lows are going to be forced to cover, and it might drive it up even higher. The dollar does typically tend to trade out a lot of the vertical declines and vertical rises that it sees. So if it rises vertically, it tends to go back and retrace that rise. And if it falls in a vertical manner, it tends to go back up and retrace that fall. And so it's had many vertical falls in the last 2 months or so. So maybe we do get a retracement of those. That would be quite a move by the dollar, and that could also play into choppiness in the equity market. The equity market tends to like a weaker dollar, and especially small caps and sort of the broad market in general. And so we might see those stocks underperform if the dollar continues to rally. Looking at the S&P 500, composite equity relative sentiment became bearish at the end of last week. When it's at that level that it was last week, the market tends to annualize negative 15%. And we're down a little bit less than 1% for the week, maybe about 80 basis points so far through 4 days, which is, like 40% annualized. And then composite equity relative sentiment is going to become neutral again tomorrow. So maybe we don't see a ton more downside. The downside that I would expect us to potentially see would be to come back to this blue line here. This blue line is the 1.618 Fibonacci extension of the high to low range from January 22 to October 22. If you take the high to low distance, you multiply it by 1.6 and 1.618, and you add that to the low point, you end up here. And you can see that was a pretty formidable resistance since July. Every time it hit that, fell down. It fell, a lot the first time. Second time it hit it, it fell a little bit less. Third time it hit it, it fell a little bit, and then the Fed cut rates and it went above it. But because that was such a formidable resistance and an important level, it wouldn't surprise me to see the market come down and test it from above. So come back down to 5638 on the S&P 500, which is only 60 points. It's only 1% fall. Maybe that happens tomorrow on NFP, before potentially stabilizing and then possibly moving higher. But composite equity relative sentiment is totally neutral, and it's sort of in an area where the market has tended to chop around and not really do much of anything directionally. So maybe we just kind of move sideways until the election, and then we get some resolution, and the market likes the fact that the uncertainty has been lifted, and then it might make a move in one way or the other. So I'm not expecting equities to necessarily launch, but I'm also not expecting them to crater as well. I tend to see them potentially just drifting sideways. Here's the chart of the composite equity relative sentiment, how the market performs in the different zones. This week we're in the 20 to 40 zone, and the market tends to not do so well, and the market hasn't done well through Thursday. But as of tomorrow's close, we'll be in this 40 to 60 range. And as you can see, since 2000, markets tended to just go sideways and maybe slightly higher in that range. Most of the move came here from 95 to 2000, but since 2000, it might be up a little bit. So it's not in a zone where we would expect the market to do big things. And if we look at the NASDAQ, again, it's kind of running into some of its Fibonacci resistance levels. This red line is the 1.5 extension. The blue line is the 1.618 extension, which, as you can see, totally rejected the NASDAQ there, and it hasn't been able to get back up to that level. I think the NASDAQ's fate and the S&P 500's fate will largely be determined by what NVIDIA does. So NVIDIA looks like it's forming a pennant. It hit the upper trend line in this pennant a week ago. At the time, I said, hey, it's at the trend line, at the upper trend line of this pennant. Maybe the market consolidates, pulls back, maybe NVIDIA pulls back a little bit. Lo and behold, that's what happened. Both the market and NVIDIA have pulled back, but their CEO yesterday said demand for their new Blackwell chip is insane, and so it's up, several percent in the last couple of days. It was up 3.3% today. I think it was up about 3% yesterday. So once again, it looks like it's pushing this trend line of the pennant. But interestingly, if we look at this narrower pennant here, the vertex is at November 6th, which is the day after the election. So it wouldn't surprise me to see NVIDIA kind of chop around in this pennant for the next few weeks until we get some resolution with the election, and then it might break one way or the other. I would expect it to break higher because I don't think that the bull market is over just yet. I'm kind of expecting that we'll get a melt up, blow off top to kind of really put, an exclamation point on this cyclical bull market. But who knows? Depending on the outcome of the election, the market might not like it, and maybe it resolves lower. And maybe the top is already in for NVIDIA and for the NASDAQ and for the S&P 500 as well. I don't think that's the case, but I wouldn't entirely rule it out given that valuations are a strong headwind at this point. If we look at Meta, which is another stock that will help drive the market, it's in this really long term, or it was in this really long megaphone pattern. It tried to break out 4 separate times this year. It was rebuffed each time until the last time, as the Fed cut rates, it blew through that upper trend line. But again, it wouldn't surprise me if, because this upper trend line was so important as a technical level that rejected it 4 times, that it might come down, test it from above to see if that now holds a support before rallying. If it does hold a support, then I would expect it to rally higher. The market will probably be in a blow off top at that point. But if it does pull back in the near term to test this upper trend line of the megaphone, and if NVIDIA does chop around in this pennant for the next several weeks, then that should probably keep a lid on the equity market as well. Here is the ratio of the NASDAQ 100 to the Russell 2000, and it's basically at the same level that it was in November of 2023. So through 10, 11 months, the last 10 or 11 months, it really hasn't gone anywhere. Over the longer term, I would expect the Russell 2000 to outperform, simply because the valuations of small caps are much better than the valuations of the mega caps, and I think the mega caps stand to lose the most if AI doesn't pan out as it's been expected to. So I would expect this to move down towards the lower end of this channel, which is a 6-year channel if you go back in time. But whether that happens immediately or not, it's too hard to say. There's just too much variability in this ratio on a day-to-day basis. But longer term, I would expect that to drift down towards the bottom end of the channel. Here's TLT, long duration bonds, which the market might be coming to its senses and realizing that a 3 point whatever yield on the 30-year doesn't really make sense in light of all the avenues and all the ways for which inflation can make a comeback, given the fact that we're deficit spending 7 to 8% of GDP, and that's only going to blow out worse if we have a recession. So it was my contention that, hey, if we have a recession, deficits explode, treasury supply explodes, they can't keep issuing on the short end in perpetuity. They're going to have to extend the duration of what they issue, and that would lead to supply at the long end and put upward pressure on rates. That's if you have a recession. If you have inflation, well, then rates should naturally move higher, because if an investor wants to make a real return, why would they invest at a rate that's lower than the rate of inflation? So it makes sense that bonds are pulling back. Whether that sticks in the near term or whether it makes another run higher remains to be seen. But I think long-term, long-duration bonds make no sense when you can own gold or energy stocks or commodities, which are perfectly suited for the environment that we're in. And here's the relative sentiment reading on TLT. It's a composite of 2-year relative sentiment, gold relative sentiment, 5-year bond relative sentiment, as well as dollar and federal funds futures relative sentiment. And it's quite bearish. This has been a quite strong predictor over the last 2 years, over the last 20, 30 years. This recent turn bullish was not met with a downturn in bonds, which was the first time in the last couple of years where this indicator hasn't gotten the direction right, or at least been flat over the duration of the signal. So it's still bearish. There's still time for this to turn lower. I think it makes sense for bonds to be lower given the environment that we're in, but whether or not this eventually does move lower in the near term remains to be seen. So that's all I have for today. If you have any questions or comments, feel free to leave them in the chat. Thanks for watching, and I'll see you next time.